Welcome to Agency Acquisitions and Exits. I'm your host, Peter Lang. Carlos Sesta. Goodness, he and I got on like a house on fire. He's a cross-border deal maker and partner at Pipeline Capital, ex-Verizon and Dentsu, as well as ex-NP Digital. It's Neil Patel Digital Company. He has administered integrations on 3 continents, has done billion-dollar deals and small add-ons and tuck-ins strategically, and now helps founders navigate pricing, structure, and the hardest part, post-close value creation at his advisory firm. He and I sat down to have a fireside chat about his experiences and what we feel the industry needs to address and become. It's a good one. Carlos, let's dive in. Thank you for joining me.
Thank you.
For the listener, it's important to note, Carlos and I had an introductory call through a prospective deal. And then he and I sidebarred. And I was like, oh, Carlos and I get along really well. And our conversation was going and going and going. I'm like, why are we not recording this for public consumption? It's useful. It's insightful. And Carlos, you bring so much value to the marketplace that you're a gem of knowledge. So I wanted to use some of this time to extract it with you, collaborate through content. And before we do that, I just want to set context for everybody who's listening. Tell them who you are and why I love and appreciate you so much now.
Yeah, I'm originally from Brazil. So I came to the US around 2000 when the high of the internet boom. Right after my MBA, I was getting into banking into that environment. So I have a lot of stories about that internet boom and bust. Seriously, I've been doing M&A for the last 25 to 30 years, depending on how you take a look at it. Mostly on the buy side. And with big companies, small companies doing deals as big as $140 billion to Series C investments or investments of 50K, all in between. Mostly, though, it has been in advertising, media, and telecom.
For someone who's not familiar with those types of deals and transactions, just bridge one concept. How different is it from those big deals all the way down to the smaller deals, given that this has been your vocation, your passion and interest?
Yeah. So the big deals is mostly in my past with Verizon. So telecom deals were enormous. They were all driven by EBITDA and cost savings. That's, and not necessarily top line. So those were really big processes with maybe 3 bankers on the buy side, another 2 on the sell side, just managing massive teams. And it was more of the front part of it is more of a valuation effort, but it's really project management. That's what it was. And, you feel like you're more of a piece of a big, train going than driving anything. And then naturally, in my career, at Verizon, it starts ascending and gets to a point where you don't get the VP level and they're bummed out and it's total, blessing in disguise. I talked to my mentors at that point, which is, I think it was great in my career to have some guys to bounce ideas off of. And then they come back and say, hey, bigger fish, smaller pond, go. You want to run the whole thing. You want to understand the origination, which you don't do today. You understand integration, which you have no experience. So that was the sort of impetus. But I just fell in love with the smaller deals and being the bigger fish because your impact is much more. You can feel if you can feel the impact, you have more of the real life experience of what a deal is. And on the other side, the risk is if you mismanage it, it's your fault. And the other thing that I really appreciated was getting in touch with entrepreneurs and getting to know them, getting close to sellers. And as you know, in the ad space, you find all sorts of early people getting out early, selling at early stage or later stage, private equity funded. So I just fell in love with media and ad because there's a whole host
more
of
dynamic. Yeah, there's
combination of deal structures and where people are in their life, combination of services and technology and consulting. And it's way more exciting now where everything's happening at the same time and AI is there just knocking at that door, questioning the value.
Yeah, it's everything all at once at the same time.
Okay.
So this is an important bridge, right? Because when you're running within a system of corporate business development in telecom, you're explaining how there's jobs and roles. Yeah. It's very much project management of a deliverable contributing to the overall acquisition and integration plan.
Exactly.
And you're just a cog in a system.
It is. But the funny thing is, I'm sorry, didn't want to cut you there, but like the connection between Verizon and the ad world were the acquisitions of Yahoo and AOL, which is a different podcast on itself, and we talk about the stories, but that it was very telling on how a huge telecom company trying to get into ad and media via ad tech using customer data. It was super interesting time and to move to ad.
Yeah, 100%. The corporate strategy of M&A is allowing most large companies to continue their survival and productive relevance because they can't. It's hard for them to change the economic systems that built these behemoths. It's hard for them to change people and process globally across their countries or subsidiaries. M&A is how they do it. Give some context because you went from Verizon to Dentsu. That's a horse of a different color.
It was, and I have to credit the guy that gave me that job, Dave Wing, which is still one of my mentors these days. He was the CFO at Dentsu at that time, and he said, "Hey, I need help. We're growing. We're doing 7 to 10 deals a year here. I need some sanity here." And I don't know if I fulfilled the prophecy there, but it was definitely like it was definitely a different animal in that the deal sizes were small, right? Smaller, because I was head of M&A for all the Americas. Deals in South America are a little smaller than in North America, but in general, they were right in the middle of the mid-market, 200, 300 of enterprise value, that kind of stuff. The interesting thing was that Dentsu was this entity with several different pillars: the creative guys, the data guys, the experiential guys, the performance guys, and each one of them separately was an internal client. So it's like I would have 9 clients, which it was super excited because I was designing strategy with them. I'll sit with them and say, "Hey, great. How do you want to grow, organically or inorganically next year? Okay, I'll come back with targets." And then we started going from there. And there, it was 9 clients, 9 buy side clients at the same time.
Yeah, it's fun. A friend of mine, Arn Lauber, he sold to the subsidiary of McGarry Bowen.
Gary Bowen.
Yeah, and so he went through the Dentsu and he was being courted by WPP and Sorrel and all of the big networks.
Yeah.
And oftentimes these founders just don't have like a purview into the buy side world of how many deals they're looking at, how many deals they're slated to close on that contribute inorganically. So, Carlos, open the hood.
Yeah.
Give a sense of what it looks like. Like, how many deals are you looking at? How many conversations with brokers, founders? What in those high volume pipeline days? What'd your calendar look like? And kind of describe it for everyone.
I needed help. So I had 2 managers when I started that I promoted them to directors, but we were a team of 4 people in a manager at the Americas. So at any point in time, our target was to close 7 to 10 deals, so almost 1 a month. In any week, we were talking to 20 targets, getting to know, and inbounds from bankers. So we would also take part on those inbounds. But there's a comment there to the whole holding group philosophy at the time. This is about almost 10 years ago now that I started. And then they weren't very good at integration, which I know everybody talks about. I'll give it this. And it's very easy to say. And I see a lot of people in LinkedIn say, Omnicom, Interpublic, no, then they're going to fumble the integration. The thing is, we had a lot of people that were thinking about integration, and we introduced integration into the process, right? That was my job. Integration was another diligence track when we were doing it. So we will get out of before closing with the integration plan that was vetted by buyer and sellers. Some of the stuff that never ends up on SPAs because it's very restrictive and things change. So sellers understood that, and sellers loved that we included them on the conversation. The problem is almost the same problem that I had at Verizon when it gets lost into the middle management hell, which is we designed everything, swim lanes. We're not going to step on your toes. We're not going to overcharge you for back office. Everything was designed, but it crumbles when it gets to middle management and their own incentives. It's always a problem on incentives, and we couldn't enforce certain things. Yep. So we just saw, work that very intelligent people did with integration just not be.
Yeah. It's interesting because it's labeled as a critique of M&A. Value creation is the intent of the deal, minimize risk, generate more cash flow, and have value creation. And in order to do so during due diligence, you have to have integration planning. Yeah. And people think integration is deferred to after close, but in most sophisticated corporate business development teams, you're planning integrations, but you're not the people managing the integrations after the fact. So you're handing over an integration plan to those middle managers, the people who have different incentives, different ways of measuring performance within their careers, and that's just not aligned. That just is soul crushing.
So when I was recently was a NP Digital, much smaller, and I got to design the whole thing, I come up with this thing that I was trying to educate people on, which is imagine a spiral with like three hubs.
Spokes.
Yeah, two spokes. One of them is price/deal structure. The other is due diligence, and the other is integration strategy. You start with one of them in a deal. It is going to change based on these other two. Okay. You start with a deal structure. You start, I'm going to pay everything up front because I want to integrate right away. I'll find some stuff in diligence that you want to address. You find risks. Oh, okay. Maybe I defer some of this payment, and all of a sudden I have an earnout. And all of a sudden you have to change your integration strategy now because earnouts are not very conducive to integration right now because you have to separate uh, financials. So you're back to square one. All right, I have to change the deal structure. So, and I think good buyers take that as part of the process. Experiential buyers will look at it and say, okay, what did we find? Okay, we'll change this. We'll maximize, we'll optimize to the current situation and go from there. But that wasn't necessarily what you find sometimes, where the finance team is telling you gotta use an earnout because that's how we manage risk.
Yeah, there's this value chain range where we can give you 100% cash on close or 100% seller finance earnout, and you're trying to figure out the sweet spot given the dynamics of the people who have to manage the asset after the fact. When you're trying to get buy-in from stakeholders, so whether it be the middle managers or the other executive teams, how did you go about explaining the deal thesis, kind of guiding them towards what you thought was a good direction for the deal versus their initial reaction to a deal?
There's different types of internal clients. Some of them are already done in the past, they understand, but the majority of them don't. They see M&A as, hey, I'm adding a capability here, which is fine, which is the operations view, right? They look for growth and where risk is going to be, and however we price it, someone else is writing the check, so it's not really sort of their problem. Most of them are open to have a discussion. I basically have internal clients that I start talking to them as if they didn't know anything about M&A and start educating them. And if they already know something, that's great, because then we can just go back and forth on, hey, I found this in diligence. I'm thinking about doing this. You're okay with this? We're going to hold some money back. It's going to upset the sellers. Are you okay with it? I'll talk with them. Okay. So we do this back and forth on a much more sort of fluent basis, but it takes quite a bit of conversation, and it's not very different from what I'm doing right now, which is advisory when talking to sellers. Many times entrepreneurs never been to the process, and you sort of try to figure out where they're coming from. Sometimes you have to explain everything. There's going to be a working capital adjustment, but they're going to take the money away from you. No, it's pretty common. It's done. So, and it's part of the value that you add. I'm happy to do that, but you never know the level of the deal sponsor that you're getting.
100%. When you looked at the goals that you've been given in a corporate business development context, they're really hard because you don't want to incentivize bad deals.
Yeah.
How do you think about it now that you've gone through it? Performance incentives and targets for inorganic contribution.
You never get paid by saying you shouldn't do this deal or let's wait 6 months. I've been through all of it, and they always judge the M&A guys for how many deals have you done this year, and you're like, it's not how you should be measuring it. What I try to do, and I got the experience to design the whole thing at NP Digital, and I just told the guys, M&A is like a muscle, and if you really want this to be a core competency, you've got to exercise it, and you got to continue to do it. It has to be programmatic, meaning do it through technology cycle, through economic cycle. Keep doing it, even if you have to reduce it, because that's how you get your portfolio of acquisitions to really produce the outcomes that you need. And you train your team, and then all of a sudden the HR person that is doing diligence, by the third deal, they know what to spot everything. So that's why you do. We design it in a way that it's like, guys, this is just like another competency, and if you do it really well, the market will well orders for that.
Yeah, it's important to note that it has to be considered a business system. It's not some magic salesperson who shows up and just brings in deals and is a deal maker. It's a standard operating procedure that expands the capability of an organization by giving them reps and exposures to other assets that are similar or complementary to them.
Yeah.
It makes your team so much better.
And you start developing like language around it. Say, okay,
Yep.
guys, and I developed this thing. Actually, I adapted it a little bit from Dentsu because they had a good playbook saying everybody should be able to explain why we're making this acquisition in a very simple way. Is this a capability acquisition? Is this a scale acquisition? Is this technology acquisition? And there's like another one that goes talent, but it sort of goes with technology. But we start educating people on this is the language that you have to use, and then it helps you think about things and not say what using the classic. Why are we doing this? Oh, because it's strategic, and then that.
Yeah, a little bit too big of a brush for that stroke. Well, let's do the bridge for the listener. So Dentsu was a programmatic buyer. They had done consistent M&A every year. There's targets around that. And then you get into MP Digital and you get to kind of design a version that's fitting for that company. So maybe give some context to the listener. What happened when you showed up day one?
Yeah.
How did you cast that role and contribution vision for the team and for yourself? And then walk us through, the engineering. Like, what did you actually put together and what it looked
like? I didn't show up on day one. What I told those guys is, I want to be convinced that you want to do M&A. So I'm going to consult for you for 6 months. I'm going to develop an investment thesis. And towards the end of it, if we're comfortable, we already start making acquisition towards the end of it and see if that works. So I did exactly that. We started talking about the core competencies of the agency and adjacent capabilities, but then we started seeing, already synergies in that coming along. And I was skeptical because, it was a new agency. I'm coming in. I know how many times people get seduced by saying, oh, I can arbitrage the multiple, right? I buy at 6 and I sell at 12. Yeah, that's part of the story, but you need to solve for a strategy because as an operator, I think a banker looks like that, like buy for 6, sell to 12, but an operator will be looking for risk. What's the risk of the execution of this? Where does growth started breaking? You could buy and sell for 12, but you sell lower EBITDA for 12, so you didn't create value. So it was that merging of the risk. So then I put together like the layers that you build in the process to mitigate those risks. So, be patient, do proprietary deals because you don't want to be pressured into doing like a bid.
overpaying. Yeah, you don't want to overpay by
overpay. Go after companies that are not for sale. It will take time. You kiss a lot of frogs. That was the ask in the beginning. I said, I'm not gonna come to you in the first 3 months with a target because it's gonna take time. I'm gonna talk to people and
put in the work.
Do programmatically. Be obsessed about integration and put yourself on the driver's seat of the target and coming to a bigger entity, and many times they start slapping costs on you. Oh, you're going to get into Salesforce with us. Well, but I use this then. Well, you have to pay. And it starts like this retrading of sorts. So I build these layers, and there was quite a bit of like education and talking to the folks that they were involved in M&A about how we want to design it, and to be able to do that from scratch was great.
Yeah. And this was it the first time Neil's company, this MP Digital was Neil Patel's company.
Correct.
And it was a performance digital agency. And he was turning on, I'm going to go out and buy. And so we're going to take it seriously by bringing in professionals who have done it before to do it now for us. And you approach it with going, everyone says that. Let's do a shorter engagement before I commit to you. And you tell me like you want to do deals, but then we shop for 2 years and do nothing. So you consult with them, ensure that they're fully bought in to doing M&A. Was it Rebel House? Was that Montreal? I remember that deal. So you show up, they get this deal from proprietary. So you're reaching out to a bunch of companies, approaching them, and you get someone who says, yes, I'm interested in taking the call. You say, we have a general integration thesis. We're a performance agency. We're looking at on creative. We think there's opportunities there from a cross sell. It's not competitive. And then we have how much bigger was MP Digital to Rebel? So when you're looking at the integration, like how did you?
Oh,
What
it
was the
was
size and scope?
15 to 1.
Oh,
Much,
perfect.
yeah.
Yeah, perfect. Safe.
And then the other thing that I wanted to do personally was I don't want to start with a massive deal with a team that it's not, I have to leverage folks to do diligence and be responsible for their own disciplines.
Yeah.
I don't want to throw a big deal in front of them. Again, big layers of risk protection, right?
Well, you
Because
learned this from Dentsu, right? The middle managers screw it up. And so
exactly,
you don't want too big of a thing for them to digest that they've never done before. Give them a safe experimentation around M&A, have a solid proof of concept so then you could do more M&A together.
exactly. Then you go higher and larger, but I didn't want to, a first one to be something that would be, give people's like the bad taste in their mouth. Build like safe protections in every corner of the M&A.
That's great. My recommendation to the marketplace is to do your first acquisition 30 at max 30% your employee count. And so that's usually gives us some safe buffer margins around human capital integrations.
Yeah.
And yes, with performance, there's some ways that gets confusing. But in general, if you're 100 people, you could buy up to 30 people as your full, first buy, and it's safer to integrate. Now you did 15 to 1. So if you're 100 people, you acquire a 15-person agency, 15-person business, even safer. There's times when you're onboarding more people than 15 that you acquired.
That's right.
So it's just the systems that exist day to day for the managers don't need to change to absorb what it is that you've acquired because they're used to hiring people to get work done. They just now have more people in a certain area that didn't exist previously. So that's great sage advice. So
the counterpoint to that, Peter, it was that in companies like Dentsu, you do like smaller deals. They're going to say, "Oh, no, it doesn't move the needle." Bigger, and it's like, okay, riskier. So
yeah, the barometer is very different at scale. So private equity backed strategics, capital market strategics, the big players, they're trying to consistently grow revenue, top line revenue for their shareholders and for the market. And so if they don't like the small deals, Carlos, like it takes the same amount of work to do the small deals as it does the big deal and it doesn't move the needle. So why are we doing the small deals, Carlos?
Yeah.
But for smaller companies, especially ones who are first doing M&A, the small ones are the safest bets. I typically advise 5 transactions not to suck. The first 3 transactions you do as an organization transform you into a progressive culture that can evolve and handle M&A moving forward. And you want those first 3 to be done as safely, minimizing risk, increasing cash flows, and having positive integration stories so you could go to market more aggressively. And this is where you and I just kind of like pat each other on the back and nod at the same words because it's the right way to do it. And sometimes people just jump in way too aggressively and you have unsophisticated buyers who've never bought before interacting with unsophisticated sellers who've never sold before. And the idea that they're going to create value together is wishful thinking without people who are facilitating safe interactions.
I agree 100%. That's why when some people, it's less popular now, but I remember when every presentation about M&A, or at least 90% that will start with, well, 70% of M&A fails. I'm like, what is behind those numbers? This is not a good place to start. It's just understanding why they fail, and it's not one reason. It's a whole host of it. So let's not start there.
Yeah, and the other critique against that statistic is over what period of time is it being measured?
Exactly.
And so you can have a J curve deal where, A because of an earnout, A because of cash on close, wrong performance incentives that need to be recalibrated years after the founders left. You don't really understand retained value until the founders have left. And now the key people who stuck around are running the business and performing independently. There's just so many considerations. I appreciated McKinsey, who wrote Strategy Beyond the Hockey Stick and did the assessment of 10 years. So a 10-year horizon, what predicted quartile movement of growth within certain sectors versus their competition. And it was programmatic M&A. The organizations that consistently built an engine to go out and acquire things that they don't have, to be expanding books of businesses, services, capabilities, and talents and technology, outperform over a 10-year horizon their competitors. But so many of the businesses we're talking about are measuring things in smaller fiscal increments, quarterly, annually, even, maybe every 3 years. But the M&A opportunity is much greater than that. And that's a mindset shift for companies, especially like when you're jumping in and doing M&A for like MP Digital and others. So how did you align the execution to the vision of NP Digital when you started making the commitment to do more than that first contract 6 months deal?
Yeah, so I had a teacher in business school that said when you can't forecast well, forecast often. So what we would do is often get together and talk about M&A strategy again. That first paper that we develop, at the 6 months consulting, come back and say, is this still relevant today? Is this relevant after this acquisition? And that's how you keep. And sometimes it would change, right? AI, for example, I wasn't there when where it really started to cause havoc on all business models, but it would be the great moment to look at it and say, pencils down on what we're doing right now. We should really take this tack here. But it is a frequency of connection with the stakeholders, and it was easy at NP Digital because it's the stakeholder was just like me as CEO and Neil himself.
When you're looking at starting that outbound, performance agencies have resources at their disposal. They're used to doing advertising. How did you approach a deal sourcing, given that Neil had a personal brand, given that the brand was, as an agency, was a little bit more known? What worked for you? What didn't work? Or did you do all things and everything?
Well, sort of did all things. I just asked people for patience because uh, it, what happened is that when you're time enough in the market to start getting connected, well, at least with 2 degrees with everybody. So it would take time, but research targets and talk to them and strike some connection with them. A business school or Verizon. At some point, Verizon had 177,000.
There's a lot of
people.
alums of the
Long.
telecoms. Yeah.
Yeah. Citigroup. I was with Solomon Smith Barney. Citigroup. So you just started being creative about these connections, but there's a component of cold outreach as well, and that's a bit of a numbers game. But eventually, when you get in front of people, you start. I think I used authenticity to get to them. I started not to be not to sound like a banker or I want to be buy your business. Say, hey, we have a program here. I don't know where you are. Would like to know you. And it's like just cultivating stuff and these relationships and authenticity sort of made a difference. But I'll tell you what, though, towards the end, AI was a big help because you have some databases out there will help you find similar companies. You signal companies in a certain space, and we will spit out for you a number of companies that you can start, especially on the cold part of the outreach.
Yeah.
AI has been, a lifesaver.
Yeah, there's wonderful tools. As of us recording this December 2025, Clay on the marketplace is doing amazing things. It used just to be the big players of data, and now it's been a lot more accessible. Instantly is another outbound tool. And then, of course, LinkedIn. You're targeting a category of the market that is actively promoting themselves and enriching online profiles.
Exactly.
It's not like we're trying to find the local fencing company who maybe sponsors their kids' ball club. We're talking about owners who are visible, actively trying to be visible online, and so it's easy to find them. So you touched on a few things where I wanted to double tap, which were centered around sourcing and having conversations.
Yep.
How much time did you, as the pipeline was growing, still dedicated to the sourcing activity versus managing the pipeline?
I committed myself to at least 2 days a week.
That's good context for everybody. Let's the double tap that again. You never turn off the pipe.
You never turn it off. So this is so important. And I usually take Fridays to do, because I wanted like a day that is a little bit more like, if I don't have any deal or closing or anything urgent, Fridays to do outreach and to do research. But I don't send emails on Fridays. Send emails on Mondays, Tuesdays, Wednesdays, the latest in the morning. You don't get that. You get more eyeballs on it.
So that's the good lesson. So you never turn off the pipe. We always have sourcing on. You're always doing outreach at least 1 day or 2 days a week that you're talking, and then you're booking those new opportunities. And then when you have an opportunity on the hook, that analysis does start taking time away. And many of my friends who work as M&A advisors or corporate business development teams, they're renting resources from the other departments within the company. So they're a small department of a few people on M&A, and the rest is just I need that person over here to help me with due diligence on client side. I'm borrowing accounting resources to help me go through the financials because maybe we don't want to do a full blown QOV.
Yep.
There's a lot of things you're renting and project managing. How much of your time then gets allocated to project management of deals, especially when you're having a pipeline of deals that may close multiple within a year? So is it 60, 40, 20, 10? Putting you on the spot, Carlos.
No, yeah, I'm trying to say, so I think the largest amount I had of simultaneous deals in sort of live mode, active will be 4 at the same time. And I needed some help. So I had one of the directors at Dentsu working with me, but,
So let's give context to people. So that's, you have a percentage of your time going to sourcing, maybe still 30%.
yeah,
Another 30-ish% going to deal analysis of the things you've sourced. Were you responsible for the financial modeling and some of the valuation, or was that supported through a vendor or some other department?
no, still within my department. So that's why
And
you
then,
start getting people, so the first
yep,
thing you outsource internally to your directors is evaluation. And can you push the deal forward? Do you understand the deal? What's next and what's next? The sequence.
yep.
That's the first thing that you push. You push to your more junior folks. But it was everything in house. I think quality of earnings was something that we would outsource. But really, 30%, and the other 40.
5 kind of bits, right? And then if you outsource or get support for finance and evaluation, which becomes a standard operating procedure, pretty straightforward. Get the numbers,
Correct.
give it to the controller or the finance team, and they'll spit out the output. The rest of it is due diligence and integration planning.
Yeah, integration planning, yeah. So
Yeah.
some of the sessions you want to be on, especially in the beginning of integration, the sessions you want to, it's sort of the handover of the target. You've been talking to them so much, and you have to be in on those meetings as well.
For a lot of people who've never bought a business before or have done it, they think of it as opportunity sifting. So you're just trying to find an opportunity. What you and I have been discussing is a systematic process to consistently create deals for the business. What does it take in you, Carlos? Skill sets, experience that makes you capable of managing that type of expectation versus maybe someone who's not a practitioner, who's thinking it has to be done by some wizard deal maker.
Yeah, I think if you're upfront about the risks and you go, okay, if you want to do this on a sporadic basis, it's not how it's designed to. It's the same thing, I think, when with asset management, when people say you want to do, day trade, go for it. But if you're not actively managing this thing, there's a sort of diversification of risk and sort of practice that takes you there on a more consistent basis. And then I do this asset management, analogy to folks, but it takes that. That's why I was telling you when I own the process and I had the ability to say, I'm going to design this. Well, let me see if you're serious about it, and we are lying, because if you just want to, I'll give you an example, okay? I will counter example it. And so before getting into this whole advisory thing, I was helping an existing bank, and I was helping with the buy side task. And then I was already in the middle of it, so they were looking at an asset, and I started questioning it. What is the investment thesis? Why do they want to buy this? And I just jokingly said, I hope it's not to be big, to get big just for the sake of getting big. And I got this stinky eye, and I was like, yes, we want to get big. And I'm like, oh, yeah. I'm not thinking like a banker. I'm thinking like a corporate dev guy. So I'm going to get off it. But, I'm being true to myself. I want to, I didn't want to buy something just for the sake of getting a fee, which gets to, I think, one of the core things that we're talking about is how a advisory is broken. Like you don't get paid for being thoughtful about timing to the market. It's all about closing. And I don't know if I have a solution for it, but maybe developing long-term relationships with clients and giving them advice for in hopes of loyalty later on is what we're living for.
Yeah. The business of brokerage is broken, and incentives have been focused on transactions.
Yeah.
The value chain of it is supportive of the transaction, and then operational responsibility of value creation is burdened on the business. And therefore, it's hard to create value when the financial incentive structures don't facilitate value creation.
No, they don't.
There's no consequence for the people who did the deal if the value is not created. And so ultimately, I view it as a few ways we can impact it. One is, although people have bought before,
Yeah.
doesn't mean they're good buyers. There's levels to this. There's ways to become a master, to have skills, to be empathetic, to be considerate, to be strategic, insightful about the business consequences. There's ways to do it, which means you say no probably more than you say yes. And then the next is just the sell side advisory is a shit show.
Yeah.
You can't have a bunch of people who can change positions in the table so quickly to try to maximize exit value and gain access to the strategic value creation of a buyer, and on the same side, be a buyer trying to arbitrage. It's just counterintuitive to value creation. So my biggest critique is, how do we create a more transparent, fair transaction zone for assets? And if we can do that by making buyers better buyers and sellers better sellers, and they don't require representation. Representation should be a facilitator who helps ensure accountability to the end state of value creation, not someone who just gets paid to make the damn thing happen. And so
Yeah.
I view this, Carlos, as the person who, like you, is doing M&A for a company that doesn't have this competency, is an advisor to the company, as a board, like a board member, like a stakeholder, and they want the future state of the business to realize an aspirational state. In order for them to assist, they have to bring something that doesn't exist top down within the company day to day. And so you're coming in and you need to have warrants in the business or equity. You need to be a partner in that business and have that mindset. You have to be an investor in that business. And then your job is to help administer a process of discovery and education so the company can assimilate anything that it wants to buy.
Correct.
And if that means saying no, it means saying no. And so the investments needs to be a pay price of entry, valid for that level of impact. Like, Carlos, when we do M&A, when we buy something, our whole thing, my default is, what do I do when I buy your content agency, your performance agency? I just buy another one just like it. That's how quickly I can de-risk the investment. I can get some critical mass, get some synergies, and make it small. I buy something very similar to it as quickly as possible to solve problems that you're not capable of solving operationally with what you have today.
Not
And
operational.
that's just a different level of intervention.
Yeah.
So I think of it as, but you're more a fan of buy side. So I've now just ranted, but let me give this some the structure here. You and I are both more favorably aligned with buy side incentives or buy side than sell side. Maybe explain that to the listener for you.
So you and I are more like, we were discussing like how the you structure the right advisory on the buy side, and because today is, typically it is a retainer plus, but the biggest payment is at closing of it.
At closing.
Actually, things that thought, good thinking over is not prioritized over just the closing of a deal, because you get paid when you close the deal. Telling your client that now is not a good time, or, oh, look at these guys' numbers and they're inflating EBITDA at this price, let's walk away. Nobody ever got paid for saying let's walk away, and sometimes it's the best answer, best advice you can give your client.
Charlie Munger famously was quoted saying, "Show me the incentive and I'll show you the decision."
Yeah, exactly. Yeah, follow the money, follow the incentive, and you see
the behavior.
Yeah.
And that's just, again, hard for founders, executive teams who've not experienced M&A consistently. Like, there's a lot of executive teams who have been acquired or have been within a company that has bought other businesses, but it's not something that is day to day for them.
No.
So it's hard for it to make its way into the strategic considerations of the company without it coming from outside advisors. And then I always appreciate Warren Buffett. He described having someone on his investment committee who's compensated to kill the deal.
This is amazing. Yeah.
It's financially compensated significantly by finding the holes in the deal. And so you have one stakeholder who's a true devil's advocate.
That's great. You create like a healthy tension between those two things.
Yes. Yeah. In my standard operating procedure, I created a game. We call it Let's Kill the Deal. And the whole goal of this exercise with whoever's involved in the acquisition, so I call it the A team, the acquisition team, or the investment committee, is to come up with all the things beyond risks. Just like, let's try to kill the deal.
Yes.
That could be a aggressive negotiation around different reps or warranties. It could be adjustments to performance. Just kill it. Like, come up with something that makes everybody feel uncomfortable to move forward with it, to get it on the table. Because by going through that process, you have a better risk compliance alignment. You're able to get through it.
That's a good exercise, because what I see is a lot of transactions, get ignored red flags because of the amount of money they already spend with third parties. It's like, oh, we invested all this money, it's like, well, but this is going to be nothing compared to the damage that this deal could do if it is a bad deal. But it's important just to get people sometimes out of the deal and put things in perspective.
And sometimes I've seen it firsthand where a department, whether that be IT or HR, raises a yellow flag or a red flag. And because of the department's flag being less consequential globally across an organization, they can massage down that flag a little bit.
Exactly.
Because they're like, oh, well, that's not that big of a thing company-wide that would kill this deal. It's a big thing for your department. I see that.
Yeah.
Cybersecurity, I see that. And we'll get to that. So it's not a real red flag. It's just a red flag to you.
Yeah. One thing I've just remembered, that where at Dentsu we tried to assess culture, and culture is a word that gets thrown. And how do how to assess culture? Oh, it's not our culture. So one thing that technical thing that we thought was very interesting is that in those integration conversations, which was another diligence work stream for us, we would intentionally put in hard conversations. Let's say, what is the reporting lines, or, there's you moving to our platform, and there might be some costs. How people react, and not only the seller, how they react to this conversation, but also my deal sponsor, if they start digging their heels and there's no meeting of the minds on the key stakeholders, it is a tangible point to look at it and say, yeah, there's culture misalignment here. Or at least the objectives of the deal are not necessarily inside the intersection of the meeting of the minds there. So yeah, we found the culture point here, and it's not subjective.
Yep. The whole core values that are listed on your website aren't your core values. Core values are the things you express in times of stress and tension. And in every interaction in a deal is due diligence. Every conversation, every prompt of discussion is a form of due diligence, and allowing us to have insights into the future state of the opportunity between these businesses. Okay. And we do the same thing. We ask the same questions in different ways.
Yeah.
To see how people respond to us being repetitive. We disagree intentionally on some things and propose them as alternatives, again, to manufacture constraints and build tension. We question with a light doubt things that are presented with strong factual evidence to see how they respond to it. And ultimately we give, but it's more insightful to response. And then that's just from the buy to seller interaction. Then for the internal team, we show up and say, the way the seller does it is better than we're doing it. We need you to adopt it. And nothing gets the first friction point or resistance to a deal is then the change management coming on our side of something we bought versus us changing other people. And people don't know that it's completely scripted. Like, it's manufactured for us to gain insights into the potential opportunity.
Absolutely. I have a story on the AOL deal. I don't know if this is true or not, but it was a story that people that talked about that Tim Armstrong, the CEO of AOL at the point, that when we were going to hire someone in his senior executive team, they would invite all of them with him for dinner. And then he would pretend that in the middle of dinner, he has to leave. And then ask his team if the behavior of the person was the same when he was in the meeting as compared to when he was not. And you can clearly, people just will give away. Some people will give away. It's like, oh, he's not here anymore. I can be myself now. So I thought
yeah, people's behavior shifts when their boss leaves. And it always does, technically, right? It creates a slightly safer environment for you to express yourself. But it's to what degree does it change? My favorite thing is I go typically to dinner. I bring the spouses. Okay. I want to see how founders interact with their spouse. I want to see when there's a disagreement or someone talks more, does the founder feel like they're losing control over the dinner with these prospective buyers. I had this happen recently. It gives me so much. How do they interact with people?
Yeah.
So I'll tell you a story. We were meeting with a prospective seller in October. They're doing 10 million of revenue, 4.5 million of profit, and it's I'm looking to buy a brokerage firm. And so they have 30 advisors. He's been doing it for 35 years, and he's 84 years old, married to a 75-year-old, his second wife. And they go to the same Michelin star dinner every restaurant every Saturday. Yeah. So everyone knows them there. So I go with them to the restaurant, and they're greeted. They're hugging the people they know, and they get approached by a new hire who doesn't know them, and their tone shifted to like how dare you almost not know what we're ordering, not know what we're going to be doing here. And it was interesting. It's fascinating. You need to go where people feel comfortable, and then get them uncomfortable to see how they interact. I put extra attention to the spouse. I let her talk. I prompted her conversations. And the gentleman who owns his company, very prideful, strong ego, powerful guy, got uncomfortable with the amount of freedom his wife was disclosing and discussing about their life and their business.
He's losing the control of the mini.
It's like I'm meeting with my prospective buyer, and he's getting visibly tense. Cuts her off so he could step in and start talking, and then overrode her again later in the conversation. And these things are just tells to the type of culture. Like, he's going to leave. If I were to buy the company, we're in the final stages of due diligence. I just need to know his temperament, because his temperament is a driving factor to the culture and the administration that those team members are used to getting. People often will stay in a business and not like their boss, but they stay there because they can handle it or they need it to do their job. You change that, now they have a reason to leave. Yeah. So it's about calibrating everything. So yes, it's so important. The other one I like is when evaluating small businesses, and they're like, well, I went to this advisor, he's added back my salaries or normalized it. I'm not really involved. Go to dinner with them and see how many times they check their phone. Go to dinner and, I don't, the business runs without us. That department runs without us, Carlos. And then just see how many times work next to them for a full day in due diligence. Like, go to dinner, go to lunch, spend all day with them, and see how active and see how frequently they get disrupted and their attention gets pulled in. It's so important, this qualitative due diligence, rather than just the quantitative.
Especially in advertising and services where, you're not buying network, you're not buying a piece of equipment, you're buying people. Yeah. Super important.
I'd like to spend a little bit of time just talking about Q of E versus commercial due diligence. You can use any case study that you want for it. There's a difference between quality of earnings and commercial due diligence, business due diligence. You've had purview into various sized due diligences. Maybe walk the listener through Q of E, how you helped the firm that did the Q of E get the things that you want from it. And then how did you still need to do commercial DD on your side, and what that looked like with the Q of E in parallel?
Yeah. So let's start with Q of E. Usually if you use an outside party, you just let them do their work, like PwC or whoever it is.
Big Four. Big Four. Just give context for the listener. It's Big Four, or you can do Big Six and get to BDO. They all have services that are similar to this, and they have a standard operating procedure.
And you need to understand the context first before you let them go, because sometimes it's a small company. If they do accounting on a cash basis, there's going to be some accounting, adjustments to it. And then you have to decide if you take that into the deal or not, based on how you're going to run the deal. But the Q of E is really more about verifying the numbers, one-off adjustments, off-balance sheet items that you'll be interesting to know in terms of risk.
And satisfying external stakeholders.
Yeah.
Like, the part of why we invest in a Q of E is we want an independent third party to have eyes on the deal outside of just the internal sponsor.
I don't want to get there and day one say, hey, there's no enough working capital on the business, or that number is really not doesn't verify, or we can't reconcile. It's pretty tactical and focused on more on the today and looking at historicals. Like commercial diligence for me, it's about verifying the health of the economic model. It does overlap a little bit of QOV when you look at how that economic model translates into the pipeline and how they're generating money. and how they're booking their revenue. It's who leads it is a little different, right? The QOB is led by one of the big four. Commercial diligence is QOB. The big four can do just like a mechanical analysis of the pipeline, but
Yep.
you need someone that is an operator to look at it and see, okay, let me talk about this client. What happened to these clients and what's the churn? So
Yep. They have no, I say that the QOV practitioners have no opinions. They just aggregate and match the data.
right.
The commercial folks, the client-centric people, operators, they have opinions.
Yeah. So there's more influence of like the commercial diligence is more strategic view, and QOV is purely tactical. Not less important because you want to see that everything is in place. But that's how we do. One of the like the good practice about commercial diligence and even culture a little bit is that sometimes when I'm acquiring a smaller company for a big company and they can pitch clients together, I would recommend that can we do one client together? Can we just like and work
Yeah.
with them in one client and see how they go? Because it can kill the deal if they're like, oh man, we thought they were organized, they're a mess, or we love them, we already know them, and it's the best commercial diligence you can do, is
Yes.
partnering with them. It's amazing. When it works, it's just everything is aligned. We know them. We know how they price things. Let's go.
Also hiring if you can. So if it's not there's not an opportunity to co-pitch current clients and it's a vertical addition, you can potentially have them service your team and just get boots on the ground, firsthand experience of what it's like to work with them. Because even when you talk to the clients, you're still talking to people who are actively paying someone for a service, so they're going to lean a little bit more positive than true interpretations of the potential delivery. So, well, let's stay on QOV just for a second. So you've done the QOV through an outside party. You're adding your commercial due diligence insights to the project.
Yeah.
If you're a smaller corporate business development department, how much guidance are you giving the operational team, the people in the business? Who are you typically wanting to recruit to contribute to that for enterprise buy-in? What's that look like?
Yeah. So it's gonna be typically someone that owns a P&L and is running a business. But not only that person, I think he or she are going to be looking at pipeline and clients, but also if there's a piece of technology or something that is more than just services, I will recruit someone else that is close to product. To the extent that we have to evaluate sales channels of that product, I need a combination of the two, the product person and
Yep.
the business person. So it's a combination of the two. I always feel like, and then obviously if there's like a piece of technology that needs someone to look at code, then it gets very specific, and you bring someone that on the developer team. But I think
Well,
first it's business, product, and tech.
and then you've done international.
Yeah.
When did human resources, especially with dealing with different geographic compliance, different labor costs,
Yeah.
when did that come in for you typically?
Yeah.
What that look like?
So usually I try to tie the whole integration work stream with a big presence of HR, because it talks about things that are the warm and fuzzies, like, don't worry, I'm going to help you here. And then during that diligence is when I get international help. But I'll tell you what, something happened beginning of this year on a deal that I didn't see coming. And it's a cultural and sort of legal. So we had a deal in Germany, and usually in the US, when you want to show to the team that we really need you to stay here and with the next phase of the company, so you extend new contracts, new contracts to them, right? And people
Yep.
feel great in the US. They value me. I have a contract now. In Germany, it's the opposite. We started talking about this, and the CEO of the company said, "Why are you doing this? Why are you changing the employment contracts of these guys?" And we said, "Well, we're sending a message like, no, in Germany, you only change their employment agreement when there's something wrong. So you're sending the wrong message." He was like, "Oh, okay." So it was something that started like we assumed that was common practice, and he came back, and I was very happy that the CEO was very open to say why you're doing this.
That's very helpful. Yeah, there's a lot of insights, especially when you're doing localization or international transactions, where you need the founder, the CEO to contribute because the assumptions you go into the project, especially if you haven't done a transaction in that country before, have a high probability of not fitting that country.
Not it.
International business is another category of it, of
Yeah,
operation commercially.
this case was sending the exact opposite message that we wanted to send. So like, yeah, no employment contracts. Like, no,
Dentsu was a Japanese company.
Japanese company. Yeah.
So, how did in culture and how you express that culture across international governance? They've done it for a long time, so they had some discipline. But in A, how did you prep assets, whether they're Canadian assets, Latin assets, U.S. assets? How did you prep these companies for the culture of Dentsu
Yeah.
in the deal?
Yeah. So they've done a good job at sort of the everything outside Japan was run out of London. The M&A committee was in London. So although I was reporting into the region, the M&A committee was London. So every time, so there was standardized M&A memos when you want to present a company to the committee, and the committee would say yay or nay. So for the sellers, it wasn't that much different culturally. We would get something that it drew the attention of the Japanese. They would get into the deal. So, for example, I did a deal that was one of the first direct to consumer agencies where the whole business of Dentsu was, big brands. Who wants to talk to Casper mattresses, And meanwhile, that was important because
Yeah.
these agents were eating their lunch, right? So
Yeah.
when we were making that acquisition, it got the attention of the Japanese entity, and they wanted to come to the US. They want to learn with them how you're doing this and what's the drivers and all that. But I'll tell you one thing that it was very interesting. It didn't quite transpire directly to the targets, but if you're in the machine and you're trying to get things approved, I forgot the term now. There's a term in Japanese that means building consensus before a meeting. So before the committee meeting, you will circulate a memo 2 weeks before, and you go to the different stakeholders building consensus. And if something didn't go well in one of those meetings, it would never make it to the committee. So the committee was really just a
Rubber stamp.
double stamping. But we were, I'm say educated, but we were made familiar with the concept. And I forgot the name. Like I should know this.
Niwawashi.
Yes, Nimawashi. Yeah,
Hi.
yeah.
Thankfully, I studied Japanese in university,
That
but
was
I was able to look it up off screen. It's not
that
like
was
I do
very.
that often.
And the way when you track the targets, they would look like, what's
Yes.
taking so long? What's taking so long with this process? Like, well, no, stay with us here. It's making its way to that.
Yeah, I mean, it's the international side is very interesting, and you've had a lot of access and have operated within that.
Yeah.
For the agency who's in the UK, in the US, who's listening to this, and who they've thought about global expansion, they've yet to operationalize it. M&A is a great way for them to get there, especially since it's a lot harder to start something in another country from scratch. So what's your advice to that local agency when evaluating or thinking about going internationally through M&A?
Yeah. So I think going internationally is much more accessible today and standardized than it used to be in the past. It used to be a big monster. It's a global community today. Standardization of numbers and the business models are quite similar. My advice is start networking with people, and either through an advisor like myself or in events, ed tech events. There's a lot of gathering of French companies, UK companies, US companies. Uh, and even like if you're part of the entrepreneurs organization, it's a great way to get there. We'll be getting some business from that. My current advisory.
Yeah, YPO, EO, Vistage, great communities where you can get introduced to founders in different countries.
You start talking to them, and when you decide to really, how do I go about doing a business? I just talk to an advisor. I mean, like folks like myself will be happy to talk about it and charge nothing just for telling you how the process works. If you build trust, when you're ready, let's talk, in the future. But I advise, first getting familiar with it by just networking and then talking to advisors. It's not as complicated as it used to be. I think you'll find that A number of companies in the UK and in France are much more open to acquisition than being acquired than before, especially in our sector where,
Yeah,
where services is martech. People speak the same language.
100%. As our final subject, we got to talk about AI.
Yeah,
So, the investment thesis for buying businesses and paying these founders, we've had present value for future expectations. And we've always had uncertainty in advertising, and it's always evolved. Digital, we had social, we had mobile. So we're used to the evolution, but it feels more compressed. Feels that evolution's happening faster, and it's more impactful in organizations. And there's a greater fear of efficiency, meaning reduction of labor, power shifting to the client rather than the agency. All of this to say, when going out and still buying assets, how are you consulting and advising agencies and executive teams on buying things in the world of AI uncertainty?
very carefully, first and foremost. But it depends on each subsector. And I think we all started with this looking, it's like, oh, AI is going to, you know, destroy everything.
Content.
Yeah. And especially the, the holding company's model of, cost, number of people working in an account plus, yeah, that has its nice, counter. But what I'm advising is to be super pragmatic about it. I have one asset that I'm advising right now. It's an experiential agency that is using AI to do really cool things with optimizing live events. So cameras all over, and then experiential, which used to be this very squishy thing. Did it go well? Yeah, we have many presenters, there's many, and you can never make it.
Measurable, fiscally measurable. Yeah.
Now there's a path to go there. So this is one example. So it's experiential, which it wasn't sexy at all in my view. It's now really interesting. It can also be attributable if you get the right permissions. So I'm asking the people to look very carefully in which one of them. It's not the same story in every single subsector of advertising. I'm getting very let's say granular when talking to clients about it. Uh, I've seen agencies that are sort of in terms of the company pyramid is completely upside down because they're everything on the bottom is now being done by AI. I'm curious about creative being generated by AI because it all reminds me of, like, I don't know, when we started using data to do marketing, and there's no
Yeah.
info. You don't need to infer anymore. I know Peter is Peter. I'm gonna serve him an
Yeah.
ad, and then the pendulum was like back. Well, but this is too impersonal. It needs to be more creative. So the pendulum was back to creative. I feel like the pendulum is gonna go all to AI, and it's gonna be ads made for bots looking at ads, but then authenticity, and it's going to be scarce, and then we're going to go back again to human touch.
Well, given that, I'm gonna challenge that. But given that, so say I agree with that, how does the creative agency sell in the next 2 years? Given that, because it's the present value for future expectations, no matter.
I think you put your bets on every chip. I think if I'm running a creative agency, I'll have the offering that is AI, but I'll have folks on standby saying, or not on standby, but like really thinking about uh, the creative process going forward. You're not going to staff a creative company like you used to. I think the days of a creative shop being acceptable to have a 10% margin because it's hard to staff, ebbs and flow, everything is project based.
Yeah.
I think that's gone. I think they have to use AI for their benefit and be able to manage the ebbs and flows with, well, this we're gonna AI the hell out of this, and to preserve margin. So I think certain sectors like the creative, I'm going to be very critical of and say that 10% is not acceptable anymore. You can't tell me that you can manage, the hiring and firing people, because now you have this tool that is amazing. And for small projects, AI
Yeah.
plus human in the loop, you probably can do it.
Yeah. Yeah. And it changes the fee structures. It makes it requires some retooling of the asset if you're going to continue to operate that asset.
I think
Now,
so.
that where I think we're at a very pivotal point is we have a significant amount of digital creative technology, professional service assets, creative assets that are administered and managed by individuals who are less enthusiastic about changing and retooling their businesses.
Oh, they're reluctant. I know.
Hesitant. Another
Yeah.
one. Hesitant,
I'm,
reluctant.
I'm married to a creative, so we have that discussion all the time. So
It's a visceral reaction to where
yes,
they see this as the enemy,
no,
and not a resource, and therefore you get a lot of the industry having an adversarial disposition to adoption, which could be catastrophic,
I agree.
especially when a lot of them are near the terminal or the mature date of management of the business. I mean, they have to sell it. They should sell it.
I agree.
If they're not going to evolve it, if you're not going to improve your business, grow it, or evolve it, you need to sell it. You shouldn't administer it anymore. And if you wait too long, it'll be too late.
It will be too late. So I have this problem now. My wife is a creative, so she's complaining all the time. Everybody's a designer this day. Everybody's like, I was like, yeah, but embrace this thing and see and rise above. Like, be the agent of change yourself. Now, don't fight it, because it's going to waste time. And to your point, then when you decide to embrace it, it's going to be too late. I think they should embrace it and get above it.
Or sell to someone who is embracing it.
Yeah, exactly. Exactly.
Yeah. So join forces with those who are enthusiastic about building a future version. Now, there's plenty who want to be the resistance, that thinks legislation will be developed that will create limitations and kind of reduce the severity of the impact.
Yeah.
The version the world we live in today, 2025, is not exactly any way, shape, or form what we imagined in 2015. And in many cases, it's still disappointing. In other places, it's transformational. 2035, 10 years from now, Carlos, this is going to be a very different system, and we will naturally evolve to address it. But if you're not the founder who's being extremely proactive at early bell curve innovation of how you can lead, be a change agent, consider selling it, partnering with people, joining forces and merging with those who are. We're at that time again where the old ad agency, the print agency, becomes the digital. And then everything was digital. And there's a few laggers because there's still tangible things and events, but it's a very small subset.
Yeah, I think the smart entrepreneurs are considering that and evaluating all options, which they should.
And I think they should buy. If you're an agency and you're in a little bit more of a legacy service deliverable, and Carlos is talking about experiential. Sam Altman said, in an AI world where AI does everything for you, we're going to give value back to human experience. So it's festivals, events, in-person interaction, and that's such a rewarding swing of the pendulum from COVID.
Yeah.
That it's going to be good for society. And if you don't do those services today, there's a lot of little experiential shops, tiny ones, because they were the small little like conference and experiential and booths and product people that didn't have big businesses. Those are companies you can go buy, acqui-hire, do transactions with, and then build them into your system and then lean towards that evolution so you can exist in a future state.
Yeah. And if you're not there, think about like I always think about the link between influencer and events, because like it's where they live, right? It's where they do their grams in an event. So yeah, that this wide open opportunity in experiential. I think small agencies that only did like events. Oh, I manage events. Well, no, you're an agency right now. So I agree. There's a bunch of opportunity there.
Yeah. It's not getting the attention that I think it deserves. But there's a lot of investments that fell flat. So COVID impacted conferences, in-person events, and so there's a few gun shy, who are just like, are we there yet? Are we investing in human festivals of all types and shapes? And human experience is going to get a disproportionate amount of capital and discretionary spending than the commerce and direct consumer consumption. Like where's this? Like we're at that state where it's so uncertain that if you're a buyer It's the best time to say, hey, small creative shop that does product and experiential, you've been underinvested in. You've been the hated stepchild of the industry that no one really wanted to do that much production work and effort. You're going to be the flower. You're going to be the future. We want to buy you. We want to embrace you. And we want to slowly expand and evolve to fit that level of transformation and impact in the marketplace.
In addition, this to someone that is like, oh my, in an industry that sub-industry that wasn't sexy at all.
Yeah.
We incentivize and like the acquirer to stay and thrive with it. I had to actually do like size of the market evaluation when onboarding at this client, and then experiential globally. 2024 was the first time that the size of the market surpassed the pre-COVID level. So 24 was
we've just ticked over that hurdle.
So 25 is going to be the second year.
And 20, I think it's going to blow up in 26. I think the same way we had a 10-year expanding market on the backs of digital and social, I think we're going to see local events, regional, nationwide, international. We're going to see just this massive investment in getting people together in ways that brands can get in front of, because it's going to be so hard to get in front of them digitally and remotely.
And I think like the holy grail of like of looking for things that are attributable is linking the digital persona with a person that is at the
Yes.
live. That's the holy grail. Like you move them with the digital, and then now they're all of a sudden they're scrolling, don't even pay attention, and now you have that person's full attention live.
Yeah, yeah. I think that's where it's going. And if anyone's listening to this doesn't operate within those categories, Carlos and I, we think you should go buy. So you should go buy. So it's pretty simple. Carlos, this is the plug time. When we were first meeting, you were in this kind of limbo discovery phase. You're out of that now. So if I'm listening to this and Carlos is someone who I think could really help my organization, what's the best way to reach out to you? How can you add value to them?
Yeah, so you can hit me on LinkedIn or carlos@makanta.com, MAKANTA. So I have a small 2-guy advisory firm now. I'm based in Rome, and my partner is based in Germany, but I go back between here and New York. I lived 26 years in the US. So it's a small shop that really can do things globally. I'm originally from Latin America, so we got all the Americas covered, and now Europe as well.
Wonderful. Carlos, always a pleasure, my friend.
It was great, man. I love it, man.
Thank you. If you like this episode, probably like one of our other episodes. Click here.